What's going on, guys? Welcome back to another video here. So in this one, we're going to be going over a pretty significant $6 trillion loss in terms of what everybody has been facing over these last couple of months, and that's going to make a little bit more sense when we get to that point a little bit later in this video here. We're also going to be going over exactly everything that you guys need to know going into this absolutely crazy week we have with an FOMC meeting coming up on Wednesday. So guys, if you do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's get right into it here and take a look at exactly what the market is looking like going into next week. So as we can see here on the daily time frame of the S&P 500 ETF, the SPY, we're not necessarily in a great spot. We slipped down below this key support level at 392. We ended up closing the week at 385.56. Now, we did have a little bit of a run up towards the end of the day on Friday, and you can see this on this 4-hour time frame here. But again, you were slipping down below these key levels of support here and running back up for a little bit of a retest here. So what we could see is that breakdown, retest, and continuing to make these more recent lows. And combining that with what we're looking at here on this weekly time frame, this pretty large bearish engulfing candle, things are not looking too good going into Powell on Wednesday. Now, taking a look at a little bit more of what type of economic data we have coming out this week in addition to Powell, home builders index right here, building permits, housing starts, existing home sales coming out on Wednesday here too. But at 2 p.m. on Wednesday, we are going to be getting the Federal Reserve's statement. We are going to understand at that point what the rate hike is going to be. Is it going to be 75 or is it going to be 100 basis points? And we're going to be getting the statements from Powell, the question and answer section right after that as well. Wednesday is going to be incredibly important. Most likely, we're going to see a lot of market volatility on Monday and Tuesday going into Wednesday as large money players, big institutional money, is positioning themselves for what Powell could potentially say. Because when you think about what's happened with CPI, some of the jobs data, the energy crisis going on in Europe right now, which we are going to touch on a little bit, we are at a very, very significant turning point in the market. Is the Fed and Powell going to come out and engage in what I would like to call a scorched earth policy, where they're essentially going to say, we don't necessarily care all that much how we're affecting all of the other different indicators in the economy. We just care about getting inflation under control by any means necessary. And that is essentially what we're going to be getting out of Powell on Wednesday. Now, thinking about this 75 basis point versus 100 basis point hike, a 100 basis point hike would be very aggressive, and we would see significant decreases in asset prices across the board here. That would not be something that is going to be good for the market. We would see significant decreases across the board. Now, what could happen coming out this week, and this is definitely a possibility, is that the talks of a 100 basis point rate hike start to get circulated around a little bit more, and you see this 18% probability start to step up a little bit more, where the market starts to price in more of a 100 basis point rate hike. If the Fed then comes out with a 75, well, that could provide for a little bit of market exuberance, as the rate hike was lower than what the market was actually expecting for it to be. So watch out for that going into this week as well. Now, kind of going into this whole situation that we have here with the overall market and what's going on, and especially with these rate hikes that we've seen, there's a very important data point that we need to discuss here. Now, coming over here as well, households net worth. So overall household net worth, you can see here it peaked in about Q4 of 2021, started to tick down in Q1 of 2022, and had this significant drop in the second quarter of 2022 here, and household net worth has decreased by about $6 trillion. Now, you might be thinking here, well, net worth is kind of an interesting data point. It's hard to calculate. It's not really what people are using to spend in the economy every single day, but there's a very specific situation that I want you guys to key in on, and it has to do with home prices not actually selling off aggressively yet. When the Fed raises rates, you're going to see mortgage rates go up. It creates less demand at certain price points in the real estate market, sending the value of these home prices lower. But what have we seen happened recently in the housing market that would give a little bit of cause for concern as we start to see this drawdown here? Well, home equity lending sees a big boost in Q2, the data shows. Home equity lending jumped over 40% on an annual basis, according to Atom Data Solutions. So people are taking out equity loans against the value of their properties here. Now, we know that the value of these homes are most likely going to decrease, so that is not the best thing to be going into right now. But the problem is that if you look at exactly how these home equity line of credits work, HELOCs are generally variable rate products. So if the Fed starts to raise interest rates even more, the interest that you're going to be paying on this home equity line of credit further increases. You're on a variable rate. Now, again, this is a similar situation to what was going on back in 2008 when the housing crisis did happen. There were a lot of variable rates where when these rates started to go up, everybody was no longer able to afford the homes that they were living in. Now, this would be a very different situation to 2008, but it is something to keep a lookout for here as we start to see these home equity lines of credits starting to jump back up. So looking at this here in this big loss of basically household net worth and where things could go in the housing market, kind of to wrap it up in a little bow with just this housing market section of this video here is, well, we know that home prices are most likely going to come down. Interest rates are going to go higher. Mortgage rates are going to come up as well. So there's really no need to be taking on any aggressive leverage right now or any crazy amount of risk in this market until things start to settle back down and we start to see that light at the end of the tunnel. Now, that light at the end of the tunnel could come in this Wednesday with Powell. You never know. Most likely it's not going to. And we're going to continue to see the terminal rate projections for where the Fed wants to take their Fed funds rate in the year 2023, continuing to maintain those increases. Right now, it recently had jumped from about 4% their terminal rate all the way up to about 4.5%. So we do have a long way to go with the Fed raising these rates. Again, raising rates, increase mortgage rates, it decreases home prices as well. And it also decreases the values of high growth assets in the short term as well, just based on those discounted cash flow models that are used to value a lot of these companies here. Now, in addition to this, when we're thinking about inflation as well, you have to be thinking about the energy market. Putin tells Europe, if you want gas, then open Nord Stream 2. President Vladimir Putin on Friday denied Russia had anything to do with Europe's energy crisis. I mean, I guess you can say that, saying that if the European Union wanted more gas, it should just lift the sanctions preventing the opening of the Nord Stream 2 pipeline. Speaking to reporters after the Shanghai Cooperation Organization summit in Uzbekistan, Putin blamed what he called the green agenda for the energy crisis and insisted that Russia would fulfill its energy obligations. The bottom line is, if you have an urge, if it's so hard for you, just lift the sanctions on Nord Stream 2, which is a 55 billion cubic meters of gas per year. Just push the button and everything will get going. So looking at this situation with energy right now, well, we are starting to see the European Union and all of those different countries in Europe trying to find solutions to their energy problems right now. But as this situation continues to develop, they're going to have to dip into other markets, further increasing the demand and increasing the prices of energy in those other markets as well. And we could end up seeing some significant increases in these energy prices, especially going into these colder months here where the demand for energy is going to continue to only get higher. So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great weekend. I'll see you guys in the next one. Peace.